Wait, stop what you're doing right now. If you're retired or if you have a parent or grandparent who's retired, this video could literally save you thousands of pounds this year. I'm talking about money that could be sitting in your bank account right now that you might not even know about. And here's the thing, 10 million UK pensioners are now paying tax, and most of them have absolutely no idea whether they should be paying it or not. That's right, 10 million. That's not a small number. That's nearly half of all UK pensioners. And the worst part, many of them are overpaying by hundreds, sometimes thousands of pounds every single year. And the government isn't exactly going out of their way to tell you about it. If that sounds like you or someone you care about, you need to watch this entire video, because by the time we're done, you'll understand exactly what's happening with your pension, whether you're paying too much tax, and most importantly, what you can actually do about it. Seriously, this information could change your retirement completely. But before we dive in, if you've got a pension or you're planning for retirement, please smash that subscribe button. We release videos like this every single week that could put real money back in your pocket. Okay, let's get into it. So let's start with the basics, because I need to make sure we're all on the same page here. 10 million pensioners. That number means something, and it's growing. But why is this happening now? Here's what most people don't realize. The tax system for pensioners hasn't kept pace with inflation and wage growth over the last decade. Your personal allowance, that's the amount of money you can earn before you pay tax, has basically been frozen. For most working-age people, it sits at £12,570. But for pensioners, it's slightly different, and that's where things get interesting. Now, I want to ask you something. Do you even know what your personal allowance is right now? Have you checked it in the last year? Because I'm willing to bet a significant number of you watching this have absolutely no idea. You just assume the taxman knows what he's doing and he's taking the right amount, but he's not always getting it right, and that's the problem. The reason 10 million pensioners are now paying tax is actually quite simple. It's because pensions have been rising. State pension increases, workplace pensions, annuities, people's income has gone up. But because of freezes on the personal allowance, more and more people are crossing that tax threshold. And here's the bit that really gets me. Many of these people didn't even realize they needed to pay tax. They just got a tax bill, or they had tax taken from their pension, and they accepted it as if it was just part of life. It's not just part of life. It's something you can actually do something about. Let me paint you a picture of who we're talking about here. This isn't just the wealthy. This isn't just people with massive pensions or significant savings. We're talking about ordinary pensioners, people who worked hard their whole lives, paid their national insurance contributions, and now they're trying to live a decent retirement. But here's where it gets complicated. Do you know what your current tax code is? And more importantly, do you know whether your tax code is correct? Because if your tax code is wrong, and they often are, you could be paying tax on money that should actually be tax-free. The government uses something called PAYE, which stands for Pay As You Earn. It's supposed to make sure you pay the right tax automatically, but the system isn't perfect, far from it. In fact, it's quite prone to getting things wrong, especially when you've got multiple sources of income in retirement. Maybe you've got a state pension, maybe you've got a workplace pension, maybe you've got a private pension, maybe you've got some investment income. When you start mixing all these things together, the tax system sometimes just gives up and applies the wrong code. And when that happens, you end up overpaying. Now let's talk about the specific groups of people who are most likely to be affected. Are you someone who's recently retired and started drawing a pension? Are you a woman who's just reached state pension age and received a lump sum? Are you someone who's got multiple pensions from different employers? Are you someone who's got savings or investments that are generating income? Are you a landlord with rental income on top of your pension? If you answered yes to any of these, keep watching, because this is directly relevant to you. Let's get specific about the numbers, because that's where the reality of this situation really hits home. The current state pension, as of April 2024, is £9,384.60 per year. That's the new state pension rate. Now, if that's your only income, good news. You're below your personal allowance, so you shouldn't be paying tax at all. But here's what happens in reality. Most people don't just have a state pension. They might have a work pension as well. Maybe they get £100 a week from a private pension. Maybe they get £50 a week. Maybe they get more. Whatever it is, once you start adding things together, you quickly get above that personal allowance threshold. So let me ask you directly, what's your total pension income? Have you actually added it all up? State pension, work pensions, private pensions, everything. Have you totaled it? Because if you haven't, you're flying blind when it comes to your tax situation. Let me give you some examples of what this actually looks like. Imagine you're a 68-year-old man. You've got a state pension of £9,000 a year. You've also got a work pension from your previous employer of £6,000 a year. That's £15,000 total. Your personal allowance is £12,570, so you're paying tax on £2,430. That's not a huge amount. But at basic rate tax of 20%, that's roughly £480 a year you're paying in tax. Now, that might not sound like a lot, but imagine this over a 10-year retirement. That's £4,800. Over a 20-year retirement, that's nearly £10,000. Still think it's not worth checking. But here's where it gets worse. Some people are paying tax when they absolutely shouldn't be. Some people have got a tax code that's never been corrected since they retired. Some people are having tax taken from their pension when they've got unused personal allowance that should have covered that income completely. And this is where things get really interesting. Do you even know if you've actually got a tax bill outstanding? Have you checked your tax records with HMRC recently? Have you registered with them as self-employed if you need to? Have you submitted a tax return? Because there are many pensioners out there who have no idea that they should have registered with the tax man, and that means they've got potential debts they don't even know about. I want to talk about the mistakes I see pensioners making over and over again. These are the things that are costing people real money. First mistake, doing nothing. Just accepting whatever tax is being taken. This is the most common one, and it's also the most costly. A lot of pensioners think, well, the government's taking it, so it must be right. It's not always right. In fact, HMRC estimates that hundreds of thousands of pensioners are overpaying tax every single year simply because they don't check. Second mistake, not understanding their income sources. You've got to know where your money is coming from. Is it all from pensions? Is some of it from savings interest? Is some of it from rental income? Is some of it from dividends? Because different types of income are taxed differently. And if you don't understand that, you could be missing out on reliefs and allowances that should be reducing your tax bill. Third mistake, assuming they're too poor to worry about tax. Here's the thing, you don't have to be rich to need to check your tax situation. In fact, if you're on a tight budget in retirement, paying tax you don't owe is even worse because you can't afford to lose that money. Fourth mistake, not keeping records. If you've got investment income or any other income that's not automatically taxed through PAYE, you need to keep proper records and you need to declare it. Fifth mistake, not knowing about reliefs. There are reliefs available to pensioners that many people have absolutely no idea about. Marriage allowance, for example. This is a relief that could save you hundreds of pounds a year if you're eligible. And most people have never even heard of it. So here's my question for you. Which of these mistakes have you made? Are you doing nothing about your tax situation? Do you actually understand where all your income is coming from? Are you keeping proper records? Do you know about marriage allowance and whether you could claim it? I want to spend some time on marriage allowance because this is a genuine opportunity for thousands of pensioners to reduce their tax bill, and it's remarkably simple. Here's how it works. If you're married or in a civil partnership, and one of you earns less than the personal allowance while the other one is paying tax, You can transfer the unused allowance from the lower earner to the higher earner, and this can save you real money. Let me give you an example. Say you're a couple. One of you has a pension income of £7,000 a year below the personal allowance. The other one has a pension income of £15,000 a year. Without marriage allowance, the higher earner pays tax on £2,430. That's roughly £486 in tax. But with marriage allowance, you can transfer the unused allowance from the lower earner to the higher earner. That effectively means the higher earner only pays tax on about £200 less of their income. And that's worth about £40 in tax savings. £40 might not sound like much, but that's £40 every single year. Over 10 years, that's £400. That's real money. But here's the shocking bit. Most couples don't know about this. And even those who do know about it often don't bother claiming it because they think it's too complicated. It's not. You can claim marriage allowance online through the HMRC website, and it literally takes about 10 minutes. So here's my question. Are you married or in a civil partnership? Do you earn significantly less than your partner? Have you ever looked into marriage allowance? Because if you haven't, you could be leaving money on the table literally every single year. Now, let's talk about something that catches many pensioners out: investment income and savings income. If you've got savings, you're probably earning interest. Maybe it's in a savings account. Maybe it's in premium bonds. Maybe it's in stocks and shares. Whatever it is, that interest is income and it's taxable. Here's where people go wrong. They assume that because their savings are small or their interest is small, it's not worth worrying about. But it is. Every pound of interest you earn is taxable income, and if you don't account for it, you could end up with a tax bill you weren't expecting. Now, there is some good news here. You've got a personal savings allowance if you're a basic rate taxpayer. That means you can earn a certain amount of interest tax-free. For basic rate taxpayers, that's £1,000. For higher rate taxpayers, it's £500. And if you're not a taxpayer at all, you get zero, but you've probably got a personal allowance that covers it anyway. But here's the thing. You need to know about this. You need to know what your interest is. You need to keep track of it. And you need to declare it if you're required to. So here's my question. Do you know how much interest you earned on your savings last year? Have you declared it? Are you keeping records of it? Because if you're not, you could be in trouble. Okay, so now that you understand the problem, let's talk about what you're actually going to do about it. Step 1. Find out exactly how much income you've got. Add it all up. State pension, work pensions, private pensions, savings interest, rental income, dividend income, everything. Get it all together and add it up. You need to know this number. Step 2. Check whether you're paying the right amount of tax. If you're on PAYE, check your tax code. Is it correct? You can do this through the HMRC website, or you can phone them up and ask. If your tax code looks wrong, ask about it. Step 3. If you think you're overpaying, contact HMRC and ask them to review your tax situation. Don't just accept it. Ask them to look at it. They can often recalculate your tax and give you a refund if you've been overpaying. Step 4. If you've got investment income or other income that's not automatically taxed, register as self-employed if you need to and file a tax return. Yes, it's a bit of work, but the alternative is potentially underpaying tax and ending up with a debt. Step 5. Look into reliefs, marriage allowance, blind person's allowance if relevant, any other reliefs you might be entitled to. Make sure you're claiming everything you should be. Step 6. Keep records. Going forward, keep proper records of your income. It's not hard. It just means keeping your pension statements, your interest statements, your rental income records, whatever it is. Keep them. You need them for tax purposes. I know you've probably got some questions at this point, so let me answer some of the common ones I get. Question 1. If I'm a pensioner, do I automatically have to file a tax return? Answer: no, you don't automatically have to file a tax return. But if you've got income that's not being taxed at source, or if you're overpaying tax, you might need to file one to claim back what you're owed. And you should definitely file one if HMRC asks you to. Question 2. What if I've already retired and I think I've been overpaying tax? Can I claim it back? Answer: absolutely you can. You can usually claim back 4 years of overpaid tax. So if you've been overpaying for the last 4 years, you can claim back the whole lot. But you need to act relatively quickly. If you wait longer than that, you might miss your chance. Question 3. What about my state pension? Is that taxable? Answer: yes, your state pension is taxable. It's classed as income, but it's income that might be entirely covered by your personal allowance, depending on how much other income you've got. Question 4. What's a tax code and why does it matter? Answer: your tax code is basically a code that tells your employer or your pension provider how much tax to take from your income. If it's wrong, they take the wrong amount. And they often are wrong, especially for pensioners, because the system hasn't caught up with changes in your circumstances. Question 5. What if I've got a pension lump sum? Is that taxable? Answer: this one's complicated because it depends on what type of pension it is. Some pension lump sums are completely tax-free. Others have tax already paid. You need to find out from your pension provider what the tax treatment of your lump sum is. Now, I want to zoom out a little bit and talk about the bigger picture here. Why is this happening? Why are so many pensioners paying tax? It's because the personal allowance has been frozen. The government has basically said, right, we're not going to increase the personal allowance to account for inflation and wage growth. What that means is that even if your income hasn't really changed much in real terms, more and more of it becomes taxable because the threshold isn't moving up. This is affecting hundreds of thousands of pensioners. It's a real policy issue. And while we could have a whole debate about whether it's fair or not, and I think most people would agree it's not fair, the important thing for you right now is that it's happening and you need to deal with it. The situation is only going to get worse. As pensions rise and the personal allowance stays frozen, more and more pensioners are going to be pulled into the tax net. So this isn't a problem that's going away. It's a problem that's getting bigger every year, which means if you're near retirement, you need to be thinking about this. If you're recently retired, you need to be checking this. And if you've been retired for a while, you need to be reviewing this every single year. So here's where we are. 10 million pensioners are paying tax. That's a lot, and many of them are paying more than they should. But the good news is that this is fixable. You can do something about it. It's not complicated. It just takes a bit of time and a bit of attention. Here's what I want you to do. First, work out how much income you've got. Second, check whether you're paying the right tax. Third, if you think you're overpaying, contact HMRC. Fourth, look into reliefs. Fifth, keep proper records going forward. These 5 things could put hundreds or thousands of pounds back in your pocket over the course of your retirement. That's not small money. That's real money that could make a real difference to your life. And please, please subscribe to this channel. We're releasing videos like this every single week that could help you with your money, your retirement, your pensions, your investments. Every week, new information that could literally save you money or make you money. So hit that subscribe button right now. If this video was helpful, please give it a thumbs up. And if you've got questions or if you want to share your own experience with this, please leave a comment below. I read the comments and I respond to them, and your question might help someone else who's watching. Finally, if you want professional help with this, if you're thinking about your tax situation and you need advice, please speak to a qualified accountant or a tax advisor. They can look at your specific situation and give you proper personalized advice. Thanks so much for watching. I'll see you in the next one.